Welcome to the live stream. Hello there, I'm Mitch Goldberg. If you're just joining me for the first time, this is a live stream about personal finance, the stock market, investing. A lot of what we cover here, aside from the usual financial stock market stuff and interest rates, is giving you strategies, time-tested strategies that help keep you invested in the market without making hasty decisions, because we always like to ask your client for strategy. What good is a plan if you can't stick to it? So we talk a lot about what not to do as opposed to what to do with your money. We want your money, like you, to work hard for you because you work hard for your money. And we want to help you get the most out of life with the money you have, with the resources. And we love, my partner and I, Bobby, we love to uncover hidden gems, things that you could do right now to improve your financial lot that you haven't even considered, that you haven't even thought of, because you don't know what you don't know. Let's take it to the market today. We finally are having a pretty bad route in the stock market. Not that today in and of itself was so terrible. We've had much worse days than this. But if you add up today, already getting October off on a down note, to how much the stock market has been down in the last 2 months, it's really starting to add up, and it's been a slow, drawn out bleed. What's weighing in the market? What changed? Why does the market keep going down? What's going to make it go back up? You want to know, and we're going to talk about that right now. So let me roll a quick intro, and we're going to do this show real quick. Stick around. It's going to be a good one. If you have any questions, hit me up in the comments. I love hearing from you. It's the best part of what I do. Words of wisdom, words of encouragement, or just a hello, or sharing your favorite emoji are always cool. Give us a thumbs up, please, because it'll help spread the good word about the work we're doing here. And here's the intro, and we're going to talk about the market. All right, just a quick news flash. If you haven't heard by now, Kevin McCarthy, Republican Speaker of the House, has been ousted. This is a first in U.S. history to see a Speaker of the House actually ousted from his job. Creates uncertainty in Washington. We are facing another possible government shutdown in about 45 days. So we'll see what happens. This won't be a problem if it's resolved in a couple of days, whoever the new speaker could be. I would suspect that we will go through next weekend. And then we'll come back from next weekend and we'll decide who Congress will vote on. You just need a simple majority to become speaker. It doesn't actually have to be a Republican. It doesn't even have to be a member of the House. But whoever gets a simple majority to be speaker is the speaker. So it's an interesting dynamic, and it's going to be exciting to watch, and we'll see if that weighs on stocks. But today, make no doubt about it, today was not a political issue. Today was all about interest rates. So what is going on with interest rates? Interest rates are rising, and they're rising rapidly. If you saw interest rates, we've been talking that interest rates are going to hit 4.5 soon on the 10-year Treasury. And I said very soon. And we did it exactly as suspected, as planned, as what I said. Hey, I'm just giving myself a little pat on the back here, okay? And I said, before you know it, we're going to be worried about 5%. And now that's the talk of the town. We were as high as 4.8% of the 10-year Treasury. Now, the United States Treasury, okay, the Treasury of the United States issues bonds when it needs to borrow money. And the bonds that it issues are called Treasury securities. So when someone like a country like China or Japan or regular everyday Americans lend money to the United States, they're actually buying bonds issued by the Treasury Department. They're called Treasury securities, Treasury bonds, Treasury notes, Treasury bills, T-bills. They're all Treasury securities. Okay, we like to slice and dice them and characterize them between notes and bonds, but they're all just Treasury securities. They're all bonds. And when you buy a bond, you get, you buy a bond, you're buying a Treasury security. You lend the United States money, and the United States pays you every 6 months some interest. And at the end of the bond, when it matures, you get your money back. And at that point, you could either take your money back or you could reinvest it into more treasuries. Luckily, there's no alternative when investors get their money back from treasuries, unlike a private citizen like you or I. Maybe we have a bond, it matures, and we use it to pay for college, we use it to pay for a house, we use it to fund our retirement. When foreign governments basically have taken dollars, they have to put the money into treasuries. They have to, that's what they do. They really don't have a choice, which is, by the way, one reason why anyone who's worried about the dollar being usurped by the Chinese yuan or the renminbi is really misguided. You need an extraordinarily deep sovereign bond market. No one has a deeper bond market than the United States. So anyway, the treasuries, out of the treasury securities, the 10-year note, the one that's issued with 10 years maturity, and the ones that have already been issued like a 30-year, but with only 10 years to go, those are the 10 years. So just think of a 10-year bond is a treasury bond with 10 years to go until it matures. And to that bond, things like interest rates are keyed off of it. I'm sorry, not just interest rates, obviously, but mortgage rates and other market rates that we pay. And when interest rates go up, it's the cost of money. So let me just explain what's the cost of money. That's the interest rate. So if you're paying 7% on a mortgage or 8% on a mortgage, and your interest is, let's say, $1,000 a month just in interest alone, that is the cost of the money. Because when you borrow money to buy a house, you're paying part of it as principal back to the bank. Really, it's almost like paying yourself back. And that the rest is interest. The interest is your cost of money. So when interest rates go up, you pay more for anything that you finance. So interest rates change the valuation of everything because they change the cost of everything. So when interest rates go up, it changes the cost of things, but typically we could have time to adjust. But lately, interest rates have been going up very rapidly, not really giving investors, stock market holders like us, time to really adjust and get a handle on what's happening with the valuation of our assets, including our stocks, our houses, etc. So it's starting to wreak a little bit of havoc, and you could see that where interest rates go up, it's causing stocks to go lower. That's a common pattern. But it's happening so quickly. And in the world of interest rates, to see the 10-year treasury, which we were talking about at a little under 4.5%, to see that go to 4.8% in about 3 or 4 weeks, it might not sound like a big deal because you think, well, stock goes from 45 to 48. That's not a big deal. We see that all the time. We see stocks go from 45 to 100 all the time. And stocks go from 100 to, 20. I mean, it just, stocks are volatile. But to see the 10-year yield, the interest rate on the 10-year bond, again, bonds that have 10 years, treasury bonds that have 10 years until maturity, to go from about 4.5 to 4.8 in a few weeks, that in the world of bonds is a very fast and very large move. And it's wreaking havoc on how investors value portfolios. We know that the value of your portfolio, of your investments, should be lower. But sometimes corporations, management, they have time to adjust to it. Companies could change their borrowing. They could do financial engineering. They could get adjusted to changes in interest rates, unless changes in interest rates happen really fast. And that's what's happening right now. We're throwing everything out at the stock market. The market is finally buckling. And believe it or not, the Dow Jones Industrial Average, which was up double digits earlier this year, is now down on the year. Yesterday, we were talking about the small cap Russell 2000 index. That went down on the year 2 days ago, down on the year. So what's next? Does the S&P 500 give up the ghost for the year? Does the NASDAQ give up the ghost for the year? So it's very difficult for investors all of a sudden. And bonds are down this year because when interest rates go up, the value of treasury bonds and other kinds of bonds like corporate bonds, municipal bonds, they go down in value. So if you have bond funds or bond exchange traded funds, there's a really good chance that not only were they down last year, they're down even more this year. And in fact, many are hitting new year lows this year, including utilities and real estate investment trusts. So the XLR, the XLU, the big ETFs that track utilities and real estate investment trusts are hitting year lows. So the conservative investors out there who are buying for income, dividends, are actually doing the worst this year. You're having a really bad year. You're seeing your money deteriorate, which goes to show you that there's more to buying a stock than just the income or just the dividend. All right, so some things that we know. This market has taken a lot of abuse. The economy has taken a lot of hits, but employment is still holding up pretty good. Layoffs have been pretty low. In fact, the job opening and labor turnover report today, JOLTS, indicated that there are more job openings in August than fewer, which is a big surprise. I'll show you the headline in a moment. We've seen consumer confidence go down, cost of everything going up. Inflation, while slowing down, does not slow down enough to get the Fed to stop raising rates. Now, the pundits are all saying that something's going to break. The Fed can't raise rates anymore. I've heard that before. The Fed could do whatever it wants, meaning the Federal Reserve. And we really have, if you keep saying every day that the Fed's not going to raise rates anymore, or they only have one more rate hike, if you say it every month, eventually you're going to be right. Remember, even a broken clock is right twice a day. But the one thing we have to watch out for is employment, because employment is the only thing that's holding up the economy. We'll see. On Friday, we have the August non-farm payroll figures. That's the big employment report. That tells you how many hours per week people worked on average hourly earnings per hour, and it tells you what the official unemployment rate is for the country. We're going to find that out on Friday, and that'll be a very big tell. We've got a couple people out here, and I'm so appreciative. We've got Jay. Mitch, you should be speaker. You could definitely do a better job. Thank you, but you know what? I would consider it my job to bring people together. And if you sit there and you say, it's my way or the highway, and I'm only going to fight for what I want, and that's the end of it, you're not going to really move forward, because you're not the type of person who understands that it's everybody's country, not just my country. So thank you so much for the vote of confidence. But, my job would be the reconciler, the bring people together in charge person. I don't know if that's what the country wants right now. Thank you, though. Thank you very much for commenting. And we got Mike Russo. Yep, good call. Hey, man, thank you very much. I really appreciate that, Michael. And pleasure to have you on the show today. Really do. It means a lot. Thank you. All right, let's take a look at a couple of things. Pop myself up here. We could take off the latest news. Okay, so the Dow down 430. It was down over 500 before. Feeling a little oversold. Wouldn't be surprised to get a little bit of a bounce back. NASDAQ down almost 2%, down 248. S&P down 58. We've seen numbers between 1% and 2% on the downside on the major averages a bunch of times. But I think when you see 430 points on the Dow, it still gets people's attention, although it's not what it used to be. I think more important, look at NASDAQ down 248 points and S&P down almost 60 points. Those are pretty big moves right there, right? Gold continues to lose its luster, no pun intended. All right, luster. And oil is under 90, so the inexorable, relentless rise seems to have peaked for the time being. And if we are going into a recession, that's a big worry. There's no reason for oil to be as high as it is. And then we have the VIX at 19, which when I say gets up to 20 is really when you start to see people worry. And then they worry till it kind of gets to about 30 or 40. So not a great setup if you're just going by the indicators that we look at all the time. Most importantly, let's take a look at the bond market. Bonds. All right, so right here, you've got the 3-month 5.5%. So you have to ask yourself, should I invest and get 5.5% risk-free? Or should I take a chance in the stock market with so many negatives piling up? It makes T-bills, remember, a treasury bond with a year or less to maturity is considered a T-bill, just the nomenclature that we give it. And the 90-day T-bill is considered the risk-free rate of return in every economics textbook. So my compliance people say, you can't say risk-free rate of return. Yeah, that is actually the term for it. That's where it comes from, the 90-day T-bill. And that is not looking like a bad place to be. What's your risk with a 90-day T-bill, you ask? I'm glad you asked. I'll tell you right now. If interest rates do eventually go down, buying a 10-year treasury bond at, let's say, 4.8% might not sound so great compared to 5.5% on a 90-day T-bill. But if the Fed starts cutting rates next year and the year after, and all of a sudden the T-bill is now like, 3%, for example, you're going to wish you were still getting 4.8% on the 10-year bond. So the risk now is that it's more tempting to keep your money all in short-term T-bills as opposed to long-term treasury bonds. But T-bills, there's a good chance that rates could be lower in the next year or two, which is why we ladder our maturities. We buy some 3-month, some 6-month, a year, 2-year, 5-year, 10-year bonds, and we ladder our maturities. So when the short-term bonds come due, we keep rolling them over into new ones while we have the long-term bonds, which locked in rates for the long term. That's how we diversify our bond portfolios with time management, time to maturity management. By the way, diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. So we will take a further look at these. I want this to be educational. If I'm getting a little boring, I don't mean to. I just really want to make sure I'm giving you the scoop. The 10-year went out today at 4.795%, but it did hit 4.8%. These interest rates going up at the rate they're going up, it does surprise me, but it's wreaking havoc for investors. To me, the rates for short term and even the 10-year, for me, my opinion, these are very attractive. And if you believe the economy is slowing down, if you believe, even if we have a soft landing, let alone a recession, to me, that means bonds right now with the current yields that they're showing are a screaming buy, in my opinion. Doesn't have to be your opinion, but to me, it's very attractive. Now, I want you to know, I don't just look at interest rates because they're high or low. The interest rate that fits the needs of the client's portfolio, of the client's needs, goals, time horizon, risk tolerance, that is what we look at. So for those who are saying, I'm going to wait to buy 10-year treasury bonds and I'm going to wait till they hit 5%, maybe they'll hit 5%, maybe they won't. But if the yield for you is a 4.7 or 4.8% yield, then splitting hairs over 0.2% or 0.3% is probably not serving your best interests. Invested for the long term, reinvesting, that's probably serving your best interest. These are the things we talk about with our clients, and I want to show you the most important thing of the day, two most important things of the day. The 30-year mortgage went out today at national average 7.72. This means if you shop around, you might see it 7.8, you might see it 7.5, you might see it 7.7, 7.76, 7.68%. You shop around for mortgages, okay? But by and large, the national average is 7.72%, and it's pretty easy to envision an 8% mortgage rate. What does that do? It just keeps the lid on house selling volume. One of the reasons you haven't seen homes go down in value yet is because nobody's selling. I don't need to imply that not one single person in the country is selling their house. It's just that the amount of sales are very few and far between, but the demand is still there. So these aren't going for bargains. But eventually we'll get to a normalized housing market where you have about 6 to 9 months of inventory in the market as opposed to about a month or two now. Eventually people, unfortunately, get sick. They become infirm. They can't live alone. They can't live in their house. People die. The houses have to be sold. And then the price of houses start to go down. Some people get foreclosed on. houses start to go down in value because more supply comes on. And then we start to get back to a more normal housing market. Plus, home builders are building pretty rapidly. And some markets are probably going to get flooded with a lot of inventory one day because it happens at the end of every cycle, in particular, Arizona and Florida, and probably Texas too. It's always the same thing. It's a boom and bust business when it comes to housing. The other thing I want to point your attention to is this: the 10-year, 2-year spread. This is the yield curve, meaning the 2-year bond, the 2-year treasury is actually a little higher than the 10-year treasury, but the difference is negative 0.36. The difference for a while was 100 basis points. Now it's only 36 basis points. The gap has been closing and closing rapidly, meaning long-term rates are going up a lot quicker than short-term rates. That is taken as an indication that once we get to early stages of a positive yield curve, could be a recession, and then we get through that, and then we get to a normalized yield curve. It happens to be very good for banks when you have a normalized yield curve. So just to let you know, a lot of things about the economic cycle, the stock market cycle we're in now, a lot of this is really very normal, and things are still playing out the way they normally do. If you want to know why I'm so calm, it's because if you follow cycles, you more or less, not to the nth degree, but you more or less know what's coming next. That is pretty much, here's the report, okay? August job openings top 9.6 million, more than expected as labor market remains strong. So it's all in the labor market. The labor market is a blessing and a curse, right? If it stays strong, interest rates stay higher for longer. If it weakens, it could stop the Fed from raising rates, even get the Fed to cut rates, but it's also indication that a recession could be on the way. So we are really stuck between a rock and a hard place until one way or the other it's resolved. And it'll be resolved when you see the labor market finally break to the downside. Thanks for watching, and I will speak with you tomorrow.